Good morning, everybody. If you are in business, one of your main objectives should be to factor in to actually make some money. And making money, we're talking about making profit. Now, that's all well and good, but at some point, you need to make sure the money that you're making ends up in your personal bank account. So the money has got to be there to serve a personal objective as well as an overall business objective. So this is the subject of today's presentation talk, call it what you want, talking about predominantly companies, your own companies, and how to get that money out of the company into your personal bank account as efficiently as possible. And by efficiently, we're talking in terms of the tax man. A few caveats before we go through who I am, what we're going to talk about today. When we talk about efficiently in tax, by the way, one thing that's really critical, as I'm going to expand on, is not to let tax dictate how you run your business and grow your business. My name is Mahmood. I'm predominantly a numbers guy. So I'm here to help businesses deal with overwhelm, connect with their numbers so they can make money, survive and thrive, and their businesses can continue to make an impact. And whichever way we carve it up, tax is one of those numbers that comes into play. In terms of housekeeping, so this is my second live stream on LinkedIn. So thank you very much, LinkedIn, for letting me loose. I've streamed before on Facebook and YouTube. So this is my new foray into LinkedIn. I'm loving the platform. I'm loving all the platforms we've got. My understanding about how these things work, I'm not a designer by trade. So if you see any interesting graphics, then obviously tell me accordingly. The show is about imparting some information. There's Q&A. So if you've got questions, throw them into there as well. I'm going to have a comment towards the end of the show about future episodes and future shows. So if you've got topics to raise, we can address those as well. If you're watching on replay, which I believe the stats say that most people do, I think you type in #replay, the comments will come to me. I always look at them and I love to feedback and answer people's commentary as well. We've already got some guests with us, people joining in. So thank you very much for sacrificing. Well, maybe it's not really a sacrifice, is it? So if you're running a business is not a 9 to 5 occupation. Lots of things are coming into our space here. So how to deliver value to customers, how the disciplines and the skills that we need. So effectively number knowledge, is an essential part of that. So hopefully you're sitting at home, relax, cup of coffee, you've had your breakfast. I'm going to have mine later on and we can connect with what's going on. So good morning to Richard. Richard from WorldMax. I'll just do the customary, just see if the technology is working, show it on the screen. There he is. Catching up with working the last 2 Saturdays. So getting back into the groove, Richard. Richard works very hard like all business owners do. So I'm glad you could join us this morning. So let me just recap what we're going to be talking about today. We're talking about your company. So if you're a sole trader or a partnership, this doesn't necessarily directly apply to you, but it may be something that goes into your thought process. So as time goes on, if you think, actually, I wish to trade as a limited company, then, this will be very valuable. I'll put a link in the comments box at the end, by the way, for resources, information, podcasts, etc., that I've produced and shared, which will give you the insight on those as well. So morning, Karen. Karen just joined as well. Now, in terms of presentation, there's 3 ways to take money out of your company. And can I just clarify here? There's a phrase that goes around in tax circles called tax evasion and tax avoidance. I'm not sure if anyone knows what the difference is between the two. Well, the difference is the thickness of a prison wall. We're not talking tax evasion, which is a definite no-no, could get you into hot water. That's not what we're talking about. We're talking about tax avoidance, which is a perfectly legitimate tactic, strategy, approach. All of us do it in life, where we say, okay, I've made some money. What's the legal way that I can actually arrange my affairs to actually minimize the amount of tax burden that I have there as well? It's a perfectly legitimate practice. Everybody who claims allowances, everybody who says, I'm going to buy it this way as opposed to that way, that's all perfectly legitimate. So bonjour Nadine, bonjour Karen, bonjour WorldMax. So let's get on with what we're going to be talking about today. Again, if you've got any comments, any queries coming up, pop them into the comment box and I'll do my best to address them directly in this live broadcast. Now, the 2 traditional routes that people have for taking money out of their company into their own personal accounts is typically a salary and a dividends route. And that's fine. I'm going to go through those two options. There is a third option that tends to be neglected, in my opinion, tends not to be looked at too much. And it's also where you can get some free money, believe it or not. So you can legitimately take money out of your company. You can benefit out of it yourself, and you don't pay any tax, and it's all perfectly legitimate. So that's going to be a good thing. We'll talk about that later on. Now, this wouldn't be effectively a numbers show unless I threw into the mix some illustrations. So towards the end of this short broadcast, I'm going to show you the 3 routes here and what the financial impact on those will be. Okay, you're probably all sitting at home thinking, okay, Mahmood, that's great. Let's get on with the show. Now, if the technology works, which I hope it will do, what we're going to do, I've got a very small presentation here in terms of slides. These slides here, by the way, just to make sure that I don't end up talking about aardvarks or zoos or something completely off topic, and it keeps everything framed. This is not a death by PowerPoint session, far from it. Now, let's see if I can get this techno to work. Now, what I've got to do here, let's bring in the slides. Just talk amongst yourselves for a second or two. And here we go. Let's bring this into the stream. And there we go. Fantastic. So, as you said, the topic is tax efficient ways to pay yourself. And what I would certainly say at the beginning, by the way, tax is certainly a very important consideration. It is a cost to the business, and it is a cost to you as an individual. So anyone who says it's not a cost, I think it's slightly, getting it slightly wrong in my opinion. However, unless we have what I call really punitive tax rates, so like tax at the rate of 80 or 90%, which we have had in the UK before, then you've got to look at something commercially. You've got to look at something in the positive terms, and then obviously certainly tax is going to be a vital thing. But I don't over dwell on the tax, but you certainly need to factor it into your decision making. Okay, so again, I haven't quite got to grips with this. There we go. So let's start from the beginning. So fundamentally, you're talking about a situation where your business makes a profit. If your business doesn't make a profit, by the way, there are certainly still routes you can look at to how you get the money that's in your company and put it into your own personal account. And fundamentally, by the way, unless you have inherited a trust fund, unless you've got a full-time occupation, your company is a side hustle, as they would call it, fundamentally your company has got to provide you at some point with a living, with a lifestyle itself. It may not be magnificent in the beginning, but it's got to provide you with a living itself. Now, within the profit cake, there are fundamentally 3 segments here, 3 slices out of that profit cake that everyone will want. There's our friends HMRC, which is the UK taxing authorities. They will want a slice of that. Typically, that slice is going to be made up of a number of different taxes. The main ones that we need to consider for today will be what they call corporation tax, which is the tax that's levied on the profits. There's going to be the tax on employing somebody. So in other words, the national insurance costs of that employee. So taxman is in the background and will want a slice of something. Now, there's you as the owner. Now, I've used the singular here, by the way, everybody, because you may be in a situation where you've got joint shareholding. You might have more than one director in the company. I'm fundamentally going to be focusing on the 2 here. That's where you are as a director of your company, or you may also be a shareholder. So we're talking about the owners of the company. If you've got a company, by the way, that's called limited by guarantee, some of these tactics won't necessarily be applicable. So we're fundamentally referring to a private company, i.e. it's got shares. So if you imagine that cake, those slices in terms of ownership, you own the slices of that company. So you as the owner, that's what we're focusing on. And obviously there's the company itself. Now, it sounds a weird thing for if you're self-employed. A lot of people think that if I'm self-employed, for me, it means you are your own boss. How you trade, though, there are typically 2 main choices. You either remain or you are a sole trader or a partnership. That's just fantastic. It works, has great benefits. Or you decide to run your business through an artificial thing called a company. Typically, it's got the letters LTD or PLC, or if you're overseas outside of the UK, it might have the letters INC after it as well. But in law, the company is a separate person. So in our brains, when we think about tax, we've got to separate this artificial being and ourselves as individuals. Now, very good question there, flagged up. I'll just share Karen's comment there. She's asking here, where are we? HMRC are not my friends. Well, yeah, that's a fair point, everybody. HMRC aren't in the business, I would suggest, of making friends with people. They would say, you know, they are there to collect revenues. I think where the battles come here with HMRC, nobody's going to send them a Christmas card list, is they are there to do a job. You've got to appreciate there are different aspects to HMRC here. And it's such a massive bureaucratic organisation here that they do sometimes mess things up. Sometimes they get into pickles. Everything's very much electronified these days. But, you know, again, we're not talking about friendships here, but they will not go away. I'm not sure if that's going to enamour HMRC to anybody today, but I'm not here as an HMRC spokesperson. So let's actually now look at the detail. Now, option one, route one, is a salary. One route for typically taking money out of the company is by a salary route there as well. Now, you have to, I suppose, emphasize a couple of things. If you take money out of your company for yourself or for your fellow directors, then you have to bear in mind it only counts as a salary if, in formality terms, you have got a payroll scheme registered. And what that means is you've completed a form some time ago or more recently where you said, my company wishes to be an employer. Once you've done that and you've registered yourself with HMRC as an employer, then potentially what you take out is a salary. There are the formalities there. So effectively each week or each month, you've got to go through a motion where you've got to run what they call a payroll. You obviously have decided in advance what you're paying yourself, and those forms have got to be submitted to HMRC. So, but salary route is certainly one thing. If all of this here, one question that lots of directors and owners will ask themselves at the beginning, how much should I pay myself for a salary, or how much should I, you know, what's the best way to take it out? Now, for me, before you start looking at the details, you've got to take a small step back and actually look at the whole picture. So think of yourself as an individual. What does your personal lifestyle require in terms of money coming out to support your household? What do you need to pay bills? How much do you need to pay the rent or mortgage? How much do you need to perhaps save, go on holiday at some point, food, you know, whatever your lifestyle is, what's the minimum requirement for that? And how often do you need to pay those bills? So if you've got a mortgage or you've got a rented property, typically you'll need money on a regular monthly basis coming out of your company to go towards paying those household bills. So first of all, think about your own personal lifestyle. Other considerations is cash. So if your company is cash poor because it's an early stage development, or it might be pivoting, or it's owed lots of money from its client base there as well, effectively paying yourself a regular salary, two things will happen. Number one, as a bare minimum, you will file something to HMRC saying, I've operated a payroll scheme, potentially there may be tax coming out of that, and you've got to pay that on a regular basis. Number two, the salary that you owe to yourself, you are entitled to delay that and pay yourself when funds become a bit wealthier. But effectively, most salary situations require some form of cash in the business to be able to service that. Now, tax obviously is a consideration here. One of the reasons, the traditional route for most people when they think about salaries, they say, okay, I've got a limited company. What I'm going to do, I'm going to pay myself a very modest salary. I'm just going to make some numbers up here. Typically, my payroll might be, say, a month, £800 to £1,000 per month. Two reasons would influence that decision for most practitioners. Number one, we have a tax called national insurance. National insurance, in terms of public discourse, in terms of conversations, isn't normally headlined as a tax, but it looks like a tax, it walks like a tax, it quacks like a tax, it's a tax. And national insurance can be quite a heavy rate if you look at the greater scheme of things. So typically, if you are going to say my salary has to be modest, I would certainly recommend that you pitch it at such a level that you as an individual still pay some national insurance contributions. If you don't, it will have a big bearing on your future state pension and any other potential benefits that you have. So I have seen situations where people literally either pay themselves no salary or they pay themselves a very low salary because they want to avoid paying tax completely. They focus on maybe their allowances, but you've got to make sure as a bare minimum you pay sufficient salary to actually earn some national insurance credits. I'm not by no means a pensions expert, but state pension typically requires 30 years worth of earnings to qualify for the full maximum state pension. As a benchmark figure, by the way, approximately £750 for the current year is the limit that you want to be paying as a bare minimum. Now, the other sort of thing about tax is it's the way when we look at the bigger picture. So if I have a company, we talked about corporation tax at the beginning. I've got a company, I've made some profits. Out of that profit, HMRC will take a slice. Now, if you pay yourself a salary, your salary costs are classified as what I call a legitimate cost of doing business. And that salary cost can be shaved off your profits become lower, and your company tax bill will be reduced as well. So you've got a bit of a seesaw exercise to do here. Paying yourself salary reduces your profits for the tax man and reduces your company tax bill. So that's a good tick box. Paying salary after a certain level means that you as the employer will pay more national insurance. National insurance headline rates for this current year that we're in is 13.8%. So the bigger the salary, the more national insurance contributions that you will pay as the employer. And obviously, the more you'll pay as the employee. So we have got a real seesaw effect. Now, there is one other factor to consider. And I'm going to reinforce that when we come on to the next slide. And that is if you've got a pension that you've got to pay into, salary counts as part of those numbers when we talk about pensions. I'm going to pick this up again on the second and subsequent slides. So let's recap. So we've got a situation, route one, to take money out of the company for yourself is based on what your personal needs are, cash flow in the company, tax. Typically, most people focus on national insurance and company tax as well. Let's move on to the second option. And typically for my experience here, it's a blended option that we're looking for, not just a one route suits everybody. So let's have a look. So here's route two. Now this is for me, having done this for about 25 plus years, and I don't know, old enough to have done that for all that length of time, running my business for all that period of time. One thing I will say is the second most popular option is in terms of dividends. Now I'm just going to pause there for a moment because before we move on to dividends in detail, I've got a great question coming in. I'm just going to pop it in there. So Richard from WorldMax has said, what's a good percentage of salary to save each month so funds are put aside to cover tax bills? A great question, Richard. I would probably say, like most practitioners, it really depends here. So typically as a headline number, if you've got a salary, I think that the question would really come, first of all, it depends what else is going on in your personal life. So if you've got income from a salary and you've got income coming from the other routes that we're going to discuss in a moment, when we look at the overall big picture, okay, then we'll know what the potential tax bill will be. I would say crudely, if you pay yourself a salary, which is equivalent or close to what's called an allowance that the government give you, which you can earn free of tax, then anything after that, typically you want to be saving about 10 pence in the pound. Again, it's a very broad number and it's really going to depend what else is going on in your life at that time. Now let's come back to dividends. Now dividends has got a particular meaning and a rationale, but it's certainly in my experience, what I read and I share with other people is typically it's the most popular route that people adopt for how they take money out of their company. I will say as a piece of background, by the way, over the last probably 10, 15 years here, there used to be a time that it was really great, actually. You could actually earn money in your company. You could pay yourself a modest salary and you could take out a big chunk of money as dividends, typically around that time, about 30K, and that would all be free of any personal tax. Now, what's happened over the last few years here is the government have cut down and removed those, if you can call them concessions or allowance or reliefs here. So suddenly now, dividends route is not as attractive as it would have been a few years ago. It still does have some benefits. So let's have a think about the considerations. Again, we've got a bit of a seesaw. Separate the two individuals. We've got individual and we've got the company. So if I use my own example, if I was taking money out of my company in the form of dividends, I'd think, okay, I take the money out of my company. Now, in the eyes of the company, dividends do not count as business expenses. So effectively, if I had made a profit of, let's say, £20,000, and I take say £5,000 out as dividends, two things will happen. Those £5,000 I've taken out do not count as business costs. So I will still pay company tax on that original figure. Secondly, when that money comes into my pocket as an individual, potentially I'm going to be paying tax on those dividends as well. How much? I'll give you a couple of headlines. And as a reminder, towards the end of the presentation, I've just got a summary where we're going to show what the impact is on all three scenarios. So this is scenario number 2. At the moment in the UK, you are allowed as an individual to have £2,000 a year free of any personal tax. So if I take £5,000 out, then the first 2,000 of that will be completely free. I don't pay any income tax. However, the rest is chargeable. How much you pay? Well, it's that classic depends, because when it gets a bit messy, we then have to consider what that individual's lifestyle is and what their total income is actually going to be. And I'm going to illustrate that towards the end, but I'll just give you a couple of little tidbits here. In the UK, just to make life even more interesting, HMRC and the government classify individuals according to what they call their tax status. And by tax status, I mean, in conversation, you can either be what's called a basic rate taxpayer, you can either be what's called a higher rate taxpayer, and it's always a great thing to end up in, or you can be what's called an additional rate taxpayer. Well, what does that actually mean in English? What does that mean in practice? It means if me, Mahmood, had a total income as an individual from things like salary, things like dividends, I might also have a second property, which I don't have, by the way, where I'm renting it out. If I look at the whole shooting match, if my overall income together, added all together, is up to and including 50,000, I'm classified as a basic rate taxpayer. If I've had a prosperous year, so I've got a high salary, I could have salary from other sources, I've got other additional forms of income, rental property, dividends, I could be doing some freelance consulting as an individual, whatever. If I add them all up in my basket of money, my basket of personal income, if that's over 50, but below 150k, I'm called a higher rate taxpayer. Now, you might be sitting at home quite naturally thinking, okay, well, what does it make? Well, bear with me till I get to the third one. If you have total personal income over 150k, so you've got potentially a company that's doing extremely well, you reward yourself very highly, your salary, your dividends, any other income you've got elsewhere, tops it up, you've got over 150k, you're what's called an additional rate payer. So let's recap. You're either a basic, you're either a higher, or you're an additional. Does it make any difference? Well, you know it does. Because if you are in category number 1, your rate of income tax is 20%. On dividends, it's 7.5%. Seems pretty good, doesn't it? Well, let's move into bracket number 2. Once you tip over into the high rate bracket, then what happens is your income, you pay 40%. Dividends, massive jump up, and it goes up to 32.5%. So that's quite eye-watering numbers there. So dividends, okay, you get £2,000 free, but the rest of it, 32.5%. That's a massive leap. Income tax doubles to 20%. Now, the last bracket, if you get to the situation where you are on that additional rate band, i.e. your total income from everywhere is 150,000 plus, then you've got The rate on tax on income is 45%. And remember, it's only in the bits in that 150K bracket. Dividends are then taxed at 38.1%. So we can see a massive jump from your status to the tax that you're going to pay. And what this means to me is two things. Number one is if you are looking at the way you reward yourself, if you are looking at the way that you get compensation out of the company, if you are looking at the ways that you pay yourself efficiently, you've got to look at the complete picture. You can't just say, let me focus on the company. You've got to connect the two together. You've got to connect your personal, your status, what else is going on in your life. You've got to connect the company, and you've got to look at that and then actually think, oh, what do I do? Having said that, here's one of the upsides of dividends. With dividends, you have a large degree of control over when you pay those dividends out, if you pay anything out at all. So dividends, typically you imagine that meeting you've had in your office, your kitchen table, you look at the prosperity of the company and you pay yourself dividends accordingly. So you can dictate how often you take them out. As a rule of thumb, there's actually nothing illegal, by the way, if you've got the relevant information, you've got the relevant paperwork, you've got the relevant evidence and all the boring administration stuff that supports it. You can pay yourself dividends on a monthly basis. Not normally what I'd recommend, but you can do it nevertheless. Typically, most people will pay dividends either on a quarterly basis or twice a year. Your frequency, that's up to you. Now, it sounds great, doesn't it? I just take the money out there as well, call it dividends. Now, there is another thing, caveat to pick that up, and that's what's called the legal. Now, I'm just going to put my officious legal hat on for a moment or two. Companies are legal things, by the way, so they're not just made up things. There's a host of legislation governing how companies are conducted and the rules and regulations. And if we think about one of the drivers behind having a company, it's either protection. So if something goes wrong, we don't want to lose our house, our personal assets. There may be a degree of risk that's going on with the industry that you're in, and therefore you want that protection that goes with it. That's great. The downside is if anyone who engages with you, a supplier, is if you can't pay their bill, is the company that's liable. So what the Companies Act have done is to put a layer of protection. And here's what it says about dividends. It says, if it's a dividend that you're paying out, the company has got to have sufficient profits that it's built up, what it might call reserves, that it can justify paying that dividend. So if you've got a startup company, if company's making losses, officially speaking, you can't make a dividend payment there. It's actually what's called illegal. You won't go to prison, by the way, but potentially it's actually unlawful. The way around that normally here is that companies will say to the individual, like yourself, I'll make a loan to you, and that loan can be converted into a dividend at some point. Perhaps a topic for another day, but dividends per se, effectively, there's got to be a legal compliance. Obviously, you've got to have the paperwork that backs it up, etc., etc. But you can control them. The other benefit of the dividends, by the way, I would probably suggest, and also a downside, is obviously it can serve as an incentive. But remember, it's got to meet the common household pot. One other thing to bear in mind about dividends, why it might be a downside, is if you're thinking about the future, which you should be, if you're thinking about retirement, you might say to yourself, actually, I need to have a pension built up. So I don't want to rely on the state pension for whatever reason. I might need to have a private pension. And I'll deal with that on the next slide here. But dividends do not count as earnings when it comes to pensions there as well. So again, that might be a consideration. Now, here's for me one of the areas. Okay, that's a fantastic question. Now, I did actually mention one other thing about the legal, and that's a great question. If I'm just going to flag that up, Nadine, if you don't mind. How much money should you leave as a minimum in your company once you take monthly salary and quarterly dividends? Fantastic question. And that's a good nudge to me, by the way, because I forgot to mention it. So here's what I would say. My personal view would be, I'm just going to leave that question up there, is so when you look at your company, how much profit it's made, you've taken off your salary. Let's say, for example, you've got a 30 grand pot left over. My recommendation would be leave sufficient money in the company such that it typically covers maybe the next 2 to 3 months worth of regular ongoing. So if you've got any commitments coming outside and you've got rent, subscriptions, bills elsewhere, Typically, make sure you've got enough cash left in the bank to cover, I would say, rule of thumb, about 3 months. If you've got any major investments coming up very soon, so you've got to buy some machinery, some equipment, some new PCs, you've got to make an investment in something, and the cash is in the business, well, again, you've got 2 choices here. I would, personally speaking, probably leave it in the pot if you know it's coming up quite soon, ring fence it. But the key thing is, do not take all the money out of the company completely. That would be my recommendation. There is a workaround, so you can extract money, call it a loan. If you can inject it back in, you're just repaying the loan. If you do that within a certain time frame, that's great. But as a general rule of thumb, 2 to 3 months worth of ongoing bills, I would say. Hopefully that's answered your question, Nadine. If it hasn't, then obviously put it in the comments box and I'll readdress it. Now, here's the last one for me. And I think this is an angle that a number of people don't necessarily look too much at, but I actually think it's a fantastic third part of the armory that we've got for extracting money out of our company. And it's about benefits. Now, again, typically, think about your lifestyle. And here's why I think this is a great way of actually looking to reward yourself. So we're talking about employee benefits. Now, remember, we've got a differentiation here. You are the director of your company. That's great. You would have had to be appointed officially at a company's house. You're on the record. That doesn't necessarily mean you're an employee for the purpose of what we're talking about here. So you've got to have a registered payroll scheme. So this mechanism that I'm talking about, plus the salary route, will only work if you actually have a registered PAYE scheme. If you don't, you can ignore this slide or think about getting one sorted out. So assuming you've got a payroll scheme registered, you are now classified as a director as well as an employee of your company. Think about your lifestyle. So think about what goes on. So do you have a situation where you like to, you know, for example, go out to eat, go to the cinema? Do you belong to a local gym? What does your lifestyle have outside of going to work, working hard, you know, creating value, doing great things for customers, running the business, building it up? What do you do in your personal space? Because what you do in your personal space, what's your ongoing commitments here, you know, could potentially be something that could be factored into a benefit regime. There's tax. Now, one of the reasons why tax is a positive thing here for benefits is because benefits are counted crudely as earnings if they're provided by the company, but there's no national insurance for the employee. So if you are receiving benefits from your company, and it could be, for example, payment of a gym membership, it could be typically, let's say, for example, and that sounds bizarre, the company could be paying your household rent, the company could be providing you with a car, the company could be providing you with a yacht or whatever, but effectively, whatever the value of those benefits are, it's seen as part of your earnings, but you do not pay any employees' national insurance. If it was a salary, you'd be paying employees' national insurance. Typically, it's at the rate of 12%. If you get dividends, it's not national insurance on there at all. However, by the way, as the employer, unfortunately, it's not completely free because in most, not all, in most benefits that you receive, there will be employers' national insurance levied on top. So we're going to factor those into account. But certainly, it's much more beneficial. There's also administration, reporting, compliance, call it what you will. So if you do provide benefits to your team, to yourself, then there will be reporting of that, typically what's called a P11D at the end of each tax year. And I think looking at the date today, they're due quite soon. So there's the reporting aspect. Now, why I like benefits as well is because there are some benefits provided to you as an employee that are actually tax-free. The company can claim that as a cost. There's no tax implication. It's all free. There's no employer's national insurance and there's no employee's tax either. Typically, main headlines, things like mobile phones. Now, the mobile phone has to be in the contract, has to be in the name of the company. So the company's got a contract with a phone provider. It can be your own one, by the way. You can transfer that across. You can have that provided. You can use it for personal calls. There's no benefit. The company can claim the cost and you can have it free of charge. Things like parking. So if you have an office outside of your house where you have to obviously go to, then if you're parking nearby, then the company can pay for that parking spot. If it's near there, as long as it's available to everybody, obviously if it's just you, it will be, then effectively that will be tax-free as well. There are other things as well, by the way, which you don't even have to bother telling HMRC about. So things like what they call trivial benefits. Typically, if you think about, if you like, I don't know, going to the cinema, if you like the occasional bottle of wine, your company can provide that to you if it doesn't cost more than 50 quid. And it's a completely tax-free. If you're a company director, by the way, HMRC don't like directors in the sense they think because they're in control, they can manipulate things to their own ends. So if it's not more than 300 quid, if it's not more than £50 a time, if it's not in your contract, if it's not expected, if it's not a reward for performance, then basically, if you're a director of your own company, I would probably say treat yourself, go to the cinema when they open up again, you know, a few bottles of wine. If it's less than 50 quid, it can't be a cash voucher, then fine, it's all tax-free. The company can claim the cost. You don't have to report it, and no employer's national insurance on it either. Now, there is one biggie, by the way, I've left till the end. Now, I will state here, by the way, I am not a pensions advisor. I know about pensions. I'm aware of them. I'm not a pensions expert. I'm not actually allowed to give advice on that. I'll give you a general overview, but you know, we have got people that we talk to about that. But pensions is an option to consider. It's a personal benefit. You might think, why is that? Well, because the company can put into a pension scheme for you. All the costs are tax deductible. There's no NIC. There's no tax implication. There is a limit, 40 grand a year. If you can't put in more than £1 million in your lifetime, but effectively you have to wait some time till you receive it. You can draw out on that as well. So I'll come back to your question in a second. So effectively, now again, the thing you've got to think about pensions very carefully, speak to an expert. Don't speak to Johnny down the pub. Don't speak to your best mate or something off the internet. Do speak to an expert because the rules are quite complex. But effectively, I would say it's an option to consider for your future retirement, and you can retire at 55 and you can draw down 25% tax-free. But think about your company setting up a private pension scheme, or you set your own one up, the company contributes into it. Now, the thing about pensions, by the way, what I will share with you is you cannot count dividends as part of your what's called your pensionable income. So if all your income comes from dividends, then that doesn't count when it works out your final pension payout. The government do allow the first 3,600, but again, if it's all dividends, it will affect your final pension payout. So again, that's another external factor to throw in to the mix. Now, so a great question there. So how are you? Haven't spoken to you for a long time. The question is benefits, is that VAT recoverable? Now, let me encapsulate that with a few other points about dividends. So if the employer provides something to you that is a benefit, typically then the company can recover VAT off that cost. You know, so if they bought something like a voucher and you've been charged VAT, if you bought a membership to something, then there's VAT on that. You can recover the VAT. There are some things that you can't claim VAT back on. So typically the most common one is a company car. Now, you know, should you have or shouldn't you? We'll deal with that on a future show. But if a company provides you with a company car, the VAT on that is not recoverable. If it's a van, by the way, so if you as a director fancy having a company van, a van is not classified as a car. It's what's called plant and machinery. Then you can recover the VAT on that. So obviously, I don't know what your lifestyle is like. If you want to go to places in a company van, then that's fine. Richard asked another question. Hopefully, Satvinder, that answers your question. If it doesn't, pop it into the chat and I'll deal with it later on. So Richard's question was, yeah, can we find out more of a list? You certainly can. What I'll do at the end of this broadcast, I've written on this topic before. So if everyone's okay with it, I'll share some links to blog posts I've done on this before, where I've got some lists, a couple of articles on there. Have a look at them. If you want a more definitive guide, if that's not good enough, come back to me. And I'll also share the link to the HMRC site. So we've got a couple of blog posts to share, as well as the HMRC site itself. They aren't that dramatic, but they are still there nevertheless. Now, here's the other thing to think about, by the way, everybody, as to why I think benefits are worthwhile considering. Now, let's take the seesaw here. And this will be illustration on the last slide. So what we've got an individual, and let's assume that individual says, okay, I need to go out. Okay, I've got a property that I'm renting. It's my own residence, and I pay my landlord £500 a month for that household rent. Now, for me to pay that household rent, I need money in my personal account to pay that out. Now, let's tie it up now. Look at the other side. For me to end up with £500 in my pocket, so to speak, my take-home pay, I've got to figure out what do I need to have out of the company in order to give me that 500 net. So typically, if it's a salary that we're talking about, the salary has got to be higher than £500 because you've got potentially things like employees' national insurance, you've got things like personal income tax. So to get 500, I might need more than 500. Typically, if it's dividends, it might be, okay, I need £500 in to pay my rent. What I've got up here to pay me a dividend, because I know I'm going to pay personal tax, it needs to be more than that figure. But however, most benefits, not all of them, by the way, most benefits are valued at what it's cost the firm to provide them. There are peculiar rules for things like cars, assets, but let's just talk generally speaking. For me, as the employer, to pay the rent for the individual, what that means is the cost of doing that is the cost of the rent. I, as the employee, will pay personal tax on it, and I, as the employer, will pay employers' national insurance on that figure. So to give me that figure that I need to go out and buy these things to spend money in my personal lifestyle, what you need to take out of the company is likely to be less, and therefore the tax squeeze will be less as well. Now, I know you'll be waiting. Let's have a look at a summation of what we're looking at here. So let's get some numbers here. Now, hopefully that's legible to everybody on the screen. So remember what we said earlier on. We talked about the 3 types of tax status. We've got a basic taxpayer, we've got a higher rate taxpayer, and we've got an additional rate taxpayer. Typically, under 50 grand's worth of income, over 50 grand, up to 150 and 150,000 pound plus. Now, what I've got, first of all, hopefully it's legible enough, is imagine you need £1,000 as take-home pay. Now, if you go through the traditional salary route, that's what the salary would be. Now, that salary, by the way, is the overall cost to the company and yourself as an individual to have that. So in other words, that takes into account the employer's national insurance. That takes into account the tax relief the company would get. So for you to have 1,000 would cost overall the company what it saves in corporation tax, effectively the employee's national insurance that would be taken off, blah, 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 is 1,356. Look down at the dividend route, it's 1,286, so it's slightly less. Still a bit of a saving. And if it was benefits that were provided to that value, it's 1,122. And the reason that would be is because you'd have effectively some employers' national insurance on there, and you'd have tax relief. Now, once we move into the next bracket, what we observe here is immediately that dividends do not become as attractive. So to give you that £1,000 take home, the salary would have to be 1,589, and that's overall cash cost for the company. The dividends would be 1,763, and the benefits would come out to 1,322. And if you go into the next bracket, the additional rate bracket, we can see dividends move away now, become less attractive, and the salary becomes slightly more attractive, and that's the benefits at the bottom. Now, just usual caveat, if there's any lawyers listening in here, I take no legal responsibility for these numbers. These are purely illustration based on assumptions, typical assumptions being that you've used up your personal allowance and you've used up all your dividend allowance. Other assumptions being is that obviously depending on what the benefits are will influence the value as well. So, but as a finger in the air heads up, I think that gives us a pretty good idea. Now, in terms of, I suppose, what next before we sort of wrap up here, this is going to be, I do a weekly broadcast anyhow. I'm doing more on LinkedIn Live. So this should just show as much for everybody. So let's just take that off to share and to get hopefully some useful information. If you've got thoughts that you'd like me to explore in future shows, drop them into here. I've got what I call like a content plan, what I'm going to be talking about. But obviously this is always in response to questions that clients have asked me over the last 25 years, as well as what I think is useful for business owners to get to grip with. It won't always be about tax, by the way. Tax is only one component here. Fundamentally, my mission, if you want to call it that, is to get businesses to actually make money, survive and thrive, and get rewarded for all the efforts they put in there. So whatever I can share to make that happen, whether it's planning, whether it's tax, whether it's about how to interpret those numbers, that's what I'm aiming to do. Ladies and gentlemen, thank you very much for all your time and company. If you've got any follow-up comments, criticisms, feedback, feed them into the comments box. I'll do my best to serve them. Obviously, I always like a bit of flattery, so I'll put that on there. Richard, thank you very much there. Hope your work of working, if I can say it properly, that means glass of water, of working is going well. So good to see you back in there. So everybody, thank you very much for your company. I'm now going to sort of bow out and enjoy the rest of your Saturday. And I look forward to seeing you guys later on in the week. So let's remove the slide. Kent, no problem. Hope you're well. And remember the strap line, your goal, make an impact while making, make an income while making an impact. So get my teeth back in there. Everybody have a fantastic Saturday. Let's bow out with a bit of music, I think would be